There has been an increase in the number of banks and other financial institutions that hold cryptocurrency. In investor portfolios, asset managers have begun to include cryptocurrencies, the first pure digital assets. In many respects, they are similar to conventional assets, but also distinct in their own right. For beginners to have a grasp of how to trade in crypto, day trading, futures trading, high-frequency trading, HFT, dollar cost averaging, and arbitrage are a few of the crypto trading strategies we will discuss in detail in this video. An efficient trading strategy can aid in mitigating financial risk. It prevents you from making irreversible financial mistakes. If you are a beginner in the domain of highs and lows, you may wish to trade on the Binance Futures testnet. The following are some of the most popular strategies among cryptocurrency traders. Day trading. Day trading in cryptocurrencies is acquiring and exiting a market position within the same day. The term intraday trading refers to executing transactions and closing them within the same trading day. Is Bitcoin, BTC, intraday trading possible? The objective of cryptocurrency day trading is to leverage on minute price fluctuations. Due to the extreme volatility of cryptocurrency markets, day trading has the potential to generate substantial profits. Day traders use technical analysis to develop trading strategies, but this is a time-intensive and risky method that is best tailored for more experienced traders. HODL, the term hodling, a corruption of hold, refers to a strategy in which cryptocurrency investors acquire and maintain their holdings for an extended period. Consequently, shareholders may benefit from the asset's value appreciation. How can you liquidate your cryptocurrency HODL gains? Holding investments for an extended period enables investors to profit from price appreciation. The HODL strategy provides investors with protection against short-term volatility and the danger of selling low and buying high. Compared to commodities like gold and silver or fiat currencies like the US dollar and the euro, cryptocurrencies have a shorter history, making them susceptible to fraud and money laundering. Crypto futures trading. Crypto futures. Trading in cryptocurrencies involves agreeing in advance to purchase or sell a certain quantity of a cryptocurrency, such as Bitcoin, at a specified future price on a future date. You can acquire exposure to numerous cryptocurrencies without purchasing them through futures trading. Individual cryptocurrency holders, for example, may purchase futures contracts to mitigate against market volatility. How then do Bitcoin futures transactions occur? Arbitrage trading. For Bitcoin and other cryptocurrencies to be profitable, traders seek arbitrage opportunities. A trader must purchase cryptocurrency on one exchange before selling it on another to engage in arbitrage on the cryptocurrency market. The difference between purchase and sell prices is the spread. Due to the disparity between liquidity and trading volume, there is a possibility that traders will generate a profit. They establish trading accounts on exchanges where the spread between the buy and sell pricing for the cryptocurrency they intend to trade is substantial. Traders incur expenses twice for each deposit, withdrawal, and transaction, which reduces their profits. As previously stated, you cannot exploit the price difference between two exchanges. HighFrequency Investment, HFT, high-frequency trading facilitates the quick purchase and sale of digital currencies by developing algorithms and automated trading bots. Developing such algorithms requires a solid grasp of mathematics and computer science and an in-depth comprehension of complex market principles. Therefore, it is more suitable for experienced investors than novices. There are four primary categories of high-frequency trading strategies: arbitrage, market making, liquidity detection, and momentum trading. Arbitrageurs actively seek opportunities to profit from price disparities between identical assets traded on separate exchanges. As a result of the correlation between low latency and price misalignment, HFTs may use latency arbitrage to profit from these disparities. Quantitative traders use HFT, an algorithmic trading strategy, to purchase and sell assets in a matter of microseconds, taking advantage of the bid-ask price difference. On the other hand, momentum trading systems can detect minute price fluctuations to profit from the volatile cryptocurrency market. Liquidity detection systems must identify the actions of other market participants, typically large institutions. Moreover, their primary purpose is to profit from the transactions of other market participants. However, remember that algorithms can adapt in real time to changing market conditions. As a result, algorithms may temporarily suspend trading during periods of increased market volatility or vastly widen their bid-ask spreads. DCA, dollar cost averaging. The DCA method enables traders to profit from market advances without exposing their holdings to market risk by investing a fixed quantity of money at regular intervals but in small increments. To employ dollar cost averaging, investing a fixed volume of money over a predetermined period is sufficient. Then, regardless of market performance, you continue to invest until you reach your goal. When utilizing dollar cost averaging, you invest at the market's peak and low points. As this is a long-term strategy, you should anticipate paying higher transaction fees when purchasing and selling cryptocurrency. Before committing to a trading strategy, you should conduct extensive market research. Scalping. To generate a profit, scalpers exploit market inefficiencies. To optimize profits, however, scalpers must substantially increase their trading volume. Before deciding when to enter or depart a trade within a single trading day, scalpers analyze the prevalent trends and volume levels. Despite the inherent dangers of the market, a prudent trader is aware of the margin requirement and other essential guidelines to avoid a negative trading experience. Scalpers favor highly liquid markets because it is less difficult to determine entry and exit points. Large investors, also known as whales, frequently employ this strategy when transacting vast capital. Range trading. Range trading is an active investment strategy in which the investor establishes a price range to purchase and sell a cryptocurrency within a given time frame. For example, if BTC is currently trading at $35,000 and you believe it will rise to $40,000 in the coming weeks, you can anticipate it to trade between $35,000 and $40,000. Buying Bitcoin at $35,000 and selling it when its price reaches $40,000 illustrates range trading. Repeat this procedure until you know that Bitcoin's price will move outside your predetermined range. Index trading. A cryptocurrency index fund is a collective investment vehicle with a diversified portfolio of cryptocurrencies. As an alternative to directly investing in a cryptocurrency, index investing involves purchasing exchange-traded funds, ETFs, such as Bitcoin Futures, or spot ETFs, or investing in indexes, such as the Decentralized Finance, DeFi, Pulse Index. Central to the team's methodology is smart indexes that preserve the advantages of direct token ownership. If they choose an index fund that reflects its underlying benchmark, fund managers do not need a large team of research professionals to help them select the best crypto assets. Investing in index funds still carries a greater risk of loss than investing in government bonds or fiat currency. Swing trading. For 1 week to 1 month, swing traders capitalize on market fluctuations. They develop trading strategies using fundamental and technical indicators. Before making a purchase, swing trading enables investors to track the price of a cryptocurrency over an extended period of time. Swing trading, however, frequently necessitates snap decisions and swift action, which is not optimal for beginners. Nevertheless, automated tools like crypto bots and signals can accelerate the execution of swing transactions. For instance, trading robots can monitor the market and purchase and sell assets based on predetermined rules. Trend trading. Trend or position traders typically hold positions for several months to profit from direction signals. Trend speculators generally reduce their holdings if they anticipate a market decline. If they believe, however, that the market will rise, they will invest for the long term. Indicators such as the moving average convergence-divergence and the stochastic oscillator can help them anticipate when a trend will change, allowing them to modify their investment strategy accordingly. Trend trading is suitable for beginners because it reduces the financial hazards associated with crypto investments. However, any trader, regardless of experience, should conduct research before placing money at risk. Please let us know if you need more explanation on these trading strategies in the comment sections. Remember to like, subscribe, and check out our next video.